how do we actually play this? Well, I'll tell you what I do, because you should find your own way in this world, but this is what I do with the markets when they're at all-time highs. I wait. And if I'm in positions, I'm letting them run, because this thing could just keep trending higher for a while. And if that happens, then it happens. I don't have a lot of positions on the indices right now. I have some stocks that I own, some options that I've done on stock market side of things. But specifically to the indices on a momentum trading basis, I like them long, but I'd like them for actual entries if we were to see pullbacks. So I'd probably buy the S&P 500 on a dip down into this area or a dip down into this area. In fact, I'd probably try at both levels. And what do I mean by try? Well, I mean, I don't know if this level is going to hold. We could come down here, fail out here, and perhaps see, a rough October month. But I'd still be a buyer for the end of the year kind of concept. Because right now where I see things, I don't see things falling off a cliff. For me to get outright bearish on the stock market, let me show you what needs to happen for me. This needs to be like almost all red. This is my quote unquote holy grail for economic data. This table right here. It really summarizes just about everything I need to know from a macro standpoint. If this is a bunch of blue charts, then that means the economic readings are beating estimations. And if these are a bunch of red charts, they're missing expectations. Now, guys, this is really big. This week, these two metrics report, and so did these two metrics report. It's a huge week because that has the potential to all turn green, or we could stay red and actually see unemployment rate turn red. That would be, so last time unemployment rate came out, it came out better than expected, which was why this is blue. And the last time around PMI numbers came out weak, which is why these two things are red. So keeping it very simple, these are economic data points that give us a pulse check on how the US economy is performing. We want to see, compared to forecasted values, strength in order to be confirmed that, okay, the economy looks good or it looks okay. Right now it's very mixed, which is where I've been at for the last month and a half, right? I've been very mixed on, my thought process on the stock market. So what I'd like to see for possible trades would be a dip across markets and for this to stay mostly blue. Keeping it really simple. The Edge Finder is currently giving us a neutral reading on the S&P 500. So for stocks, waiting for a pullback. If we get it, great. If we don't, I have nothing to do there. Hopefully that makes sense. That's all I wanted to say about the S&P for today so far. Let's take a look at gold. So gold, here's what we want to see for gold. So for gold, we've had a really strong run up. Price action shows bulls are still very much in control of this market. Many different metrics you could use. You could apply moving averages. Beautiful uptrend. We've strayed a little away from the moving averages, so we very well may see, a corrective pullback. But to think that this is a bearish, there's just a straight bull trend, right? This is an incredibly strong trend for gold. That doesn't mean, though, that it can't take a break. And in fact, I think gold, I would not be surprised if we do take a bit of a break. So you have jobs data coming this week. And for NFP, what does gold really want to see? Well, in my view, and the way the Edge Finder is scored, which is, of course, our scanning software that I just showed, if this is a not great report for NFP, that's going to be good for gold. Okay, so why? Remember, gold typically thrives on a weaker dollar and weak global economies, because weak global economies lead to central banks pumping money into the system, creating more fiat currency to try and save the day. More fiat currency makes the value of, risk havens like gold go up. If there's more dollars in circulation, the value of gold should theoretically go up. It's not exactly perfect like that, but that's the idea. So as we look at gold here, trading higher into NFP week, if we get a big pullback, I'm probably going to look to buy that dip if NFP is confirming. Now, again, a lot of traders will only focus on the technicals, which is totally cool if that's what you like to do. But to me, I feel like I'm trading blind if I don't have the fundamental story in tandem with the technicals. This chart is going to look really overbought if NFP comes in really strong this week. Okay, that's my opinion. If NFP comes in like red hot, like, oh, we got a strong jobs data point, you'll probably see gold correct hard. Now, I'm not saying that's what I think is going to happen. So that's what we need to be aware of. Now, I understand sometimes people will watch my videos and they'll be like, Nick, you're kind of talking out of both sides where you actually think it's going to go. So I do as little forecasting in the markets as I possibly can. I look at what's actually showing up in the data, and I look for pullbacks in strong trends that I think the fundamentals confirm. So I like gold to the long side. I'd like to see this thing pull back, and then I'd look to buy it. That's how I'm looking to trade gold. Maybe this level, but the reason I can't just say, oh, I'm going to buy here with a stop loss here is because I don't know what the fundamental story looks like at that point. Fundamentals play a very key role in whether or not I choose to buy or sell something. So I can't tell you, oh, this is where I'm going to put a pending buy limit with a stop loss here. It's going to be easy money. No, right? I got to look at what we are dealing with at the time that we do get that pullback.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
A couple things here. Lots of currency pairs currently. Nikkei is back on the bearish watch list, but I don't like the price action there. The Australian dollar, the pound US dollar, the Kiwi dollar. I'd like to look at those a little closer, just see what's going on. Also, I had a question for you guys. Is anybody else's Fibonacci retracements doing weird stuff this morning? I think TradingView might have like a bug or something on their software. Can you guys try that on your... Did anybody else notice this? If you try and draw a fib, it's definitely bugged out for me at least. I'm curious if that's the same for other people as well. Anyways, the pound US dollar looks pretty strong. If it pulls back here, I do like it for potential long setups. I'm staying pretty bearish on the dollar at this time. Until further notice, until you get some sort of real strong, okay, other people are yeah, other people are seeing it too. Okay. What was I saying? Yeah, so anyways, I do like pullbacks on the pound. Nice confirmation from the edge finder as well. So I'm definitely keeping an eye on that one. Pound US dollar, NZD US dollar. Let's take a look at the Kiwi dollar. Yeah, look at how weird my fibs look. That's so frustrating. Kind of already got this pullback into play, but if it comes back, I'd be potentially willing to try that out. Can you share with us your thoughts on copper?
Yeah, absolutely. So I'm looking for essentially two different approaches on copper. So I'm looking for an intraday position on the H1 here, looking for potentially a reversal at the 200 moving average. This is basically just a technical setup. And we've got the RSI here that's becoming oversold. We've got very minor support through here. So we might be able to catch just a small intraday pull. And then the second approach, if this fails, is a more long-term swing trade here. So we're looking at the daily. So we can see we've just rejected the 4.6 level roughly, rejected it quite aggressively, really. So if we draw the fib from low to, actually I need to just slightly adjust that, from low to high, we can see through sort of the 50% to the 0.618, we've got another level of structure that could act as quite a nice support. So yeah, I still remain bullish on copper. There's not really anything, in my opinion, that is standing in the way. I mean, you know, weaker China data could come into play. But for now, I'm still relatively bullish.
I was going to say on the China front, the big pop in the Chinese stock market could turn out to be a positive thing for copper as well, I would imagine, just because if you do get the Chinese economy, which of course is a very heavy manufacturing economy in the world, if you get China starting to pick up again, the demand for commodities, both oil, copper, silver, all sorts of different things, iron, all those things could very, very heavily be seeing a bit of an upside move. So I don't hate the trade at all. I think, especially if you think globally, the world's not going to go into, a big recession. Copper starts to look interesting from strictly a commodities play. That's a pretty pure, industrial commodity play. So I thought that was interesting. That's what stuck out to me on your video. What else are you watching?
There's a few really. So we're looking at gold. Obviously, I think most people have eyes on gold at the moment. So yeah, just still looking for some sort of pullback, which we seem to be getting today, which is quite nice. I'm still a little bit jealous of your gold trade. We were in very similar positions, except I was a bit too aggressive with the trailing stop there. So yeah, just looking to get back in, whether it's from profit taking or a slight weakening in some of the global factors. I'm not too sure yet. Let me just take a look here. Pound Swiss is also one that is very, very good, mainly driven by a central bank divergence. So I'm sure, as you know, the Bank of England held their rates. The balance of trade from the Swiss is weakening. We've got the Swiss that's viewed as overvalued, which the Swiss National Bank isn't overly in favor of really for the long term. We've also got the Swiss National Bank cutting rates. They just cut 25, so they possibly will cut again in November. So this one could be quite a solid long-term trade.
Yeah, no, I like it. And I've been keeping an eye on the currency side of things, looking at the dollar, the Swiss franc as well. The other one is, of course, keeping an eye on the yen, just because, again, this kind of signals the Bank of Japan. I think they just had some big leadership change, and the guy is perceived to be a bit more of a hawkish banker, meaning willing to let the yen stay strong or do what it takes to keep the yen strong, perhaps hiking rates, things like that. So might be an interesting change. You can see the big reaction here. It doesn't look so big on the daily chart, but big swing lower on that was Friday. So we'll see how that comes into play, because of course a stronger yen could be an interesting thing for global markets. If you get a big strengthening of the yen, that can sometimes be a bit concerning to global, margin call, global borrowing costs, etc. So
yeah, well, that's the big thing. I mean, sorry, I didn't mean to interrupt you there. But yeah, the yen for so long has essentially just been a short the yen, buy everything else really. So the fact, if hypothetically, if the yen strengthened very, very quickly, it would have a ripple effect, I'm sure, as you know, across a lot of different markets, affecting almost every trade, whether it's retail or institutional. So it would be obviously maybe beneficial for Japan, but very negative, I'm sure, for a lot of the world or a lot of the banks. We'd see stock markets, we'd see currencies, we'd see all sorts of things go a little bit pear-shaped for a while. So yeah, I think anyone that's looking at the yen, I wouldn't suggest we're suddenly going to see a rocket. I would suggest, if you are looking, maybe we'll see a trickle up to the upside over a longer period of time. But yeah, for now, I think it should, in theory, be a stable move rather than something that should just spike.
Yeah, no, good points there for sure. And always one to keep on the radar, just like you said. Everybody keeps an eye on gold. The yen is also, even if somebody in the audience is not a currency trader whatsoever, I think if you're going to look at two currencies, it's first the dollar, second probably the yen, because the yen, usually holds the key on kind of global sentiment.
The next one that I'm paying quite close attention to is the pound against the US dollar. So the reason is, I mean, as I previously mentioned, that we've got the Bank of England holding their rates at 5%. We've got the Fed, obviously, which just cut 50 basis points or 0.5%. We also have likely another rate cut coming in November from the Fed. So we've got quite a nice central bank divergence here. So essentially, we'd just be playing that. We've got relatively stable data coming out of the UK or the United Kingdom. So overall, this trade looks very, very simple. I mean, even if you look at the trend, if you watched any sort of technical analysis tutorials or anything trading related, you'll know trends are always drawn in a very simple uptrend. And this is one of the rare times where it is actually just that simple in the markets. I mean, if we look at the pound index right here, look at how smooth the trend to the upside has been. So, you know, sometimes if something looks too perfect, it's normally something is wrong. So this trade might be one of those, a catfish trade, as you could call it, where, you know, it looks great and then it's not quite as it appears. But for now, the trade seems okay. So I'm looking to enter on this 50% level, which coincides quite nicely with this trend line, just simply following the trend and the central banks. Right now, it's just broad-based by Chinese companies. You will earn money. That Chinese stimulus hasn't even hit markets, and Chinese stocks are up so much. Imagine when stimulus money hits. Yeah, Jacob, that's a good point. Could be interesting. Greetings, bro. Trading stocks long short. Do we look at domestic data, underperforming / overperforming stocks, earnings, economic cycle, central bank mandate? Honestly, for stocks, you're asking the wrong person. I am just a currencies trader in commodities. So I can't really tell you anything. The most I know about stocks really is just looking at earning reports and projected earnings. And potentially, depending on the stock, seasonality and historical data can come in quite nicely. But yeah, obviously for the indices, you would need to look at the central banks and interest rates and things. So there you go. So moving forwards, Brent oil seems quite nice to go to the downside. So I've been stuck. Well, not stuck, that's probably the wrong word, but I have been looking to go long on oil. I've now changed that idea to go short. So we've got, now this is also something I should probably say, is if you see a market gap on TradingView, you need to double check it with your broker, because market gaps can be either real market gaps where prices fluctuated over the weekends and opens at a different price, or there's a market gap where it's just a difference in data, essentially, with your broker. So just keep that in mind if you are trading using market gaps. However, with UK oil, there is one here on just TradingView. Again, I haven't actually checked it. not practicing what I preach here, but there is a market gap on the TradingView one here. So looking for the 50% pullback into this level of structure, we can see through here on the H4, slightly roughly drawn, but you get the idea. Looking to take it down to sort of 66. But yeah, very simple. Again, just trading the trend here. So the reason is, despite long-term optimism, Brent oil faces short-term downside risks due to a projected supply surplus and weaker demand from China. Goldman Sachs forecasts a gradual decline in oil prices as supply increases from the US, Brazil, and OPEC plus countries. Additionally, global growth concerns, particularly in China, could weigh on oil prices. So there you go. I mean, oil is actually a very simple thing to trade, really. It is just supply and demand, really. It's, you know, if they're cutting the supply, then demand goes up, prices goes up. If they increase the supply, demand goes down, prices go down. Obviously, there's slightly more to it than that, but generally speaking, it's normally quite an easy one.
So the S&P election year, there's a lot of stuff out there that's being sprinkled around. It's like it matters. I mean, this is 1949 to 2022. So if there's anything that gives us some history, I'm all for it, right? So all election years, and we said this going into this year, if you were, you know, with A1 trading all last year, with this at all this year, we know it's an election year. Obviously, there's already been some election drama with Joe Biden dropping out, you know, Kamala Harris getting nominated without actually going through a primary, Trump coming back after however many lawsuits the guy's dealt with and nothing stuck to him, and now he's running for president, whatever. All election years are here in black, okay, expecting to be positive on the year. The cycle, especially seasonality-wise, look at this October, November. Everybody see that right there? October to November, as we head into the election, even in the election years that are positive, usually there's a little bit of chop prior to the election. So does that mean we have to have a down move? No, it doesn't mean that, but it would make sense over a 72-year pattern that the market probably has this for a reason, because there's some indecision going into the election. We know that there's more to it than just the election. We're in an interesting spot with the Fed. They just cut rates 50 basis points. They're likely going to cut another 25 by the end of the year. So the Fed's looking at a pretty aggressive 1% cut roughly by the end of the year. With an election, right, with earnings season, with employment news that the market's going to be sensitive to, with inflation data the market's going to be sensitive to. So is this always the same? And having this, I'm super confident this is going to be what the year plays out to be. Not really. There's a lot of other factors that build into what is the market going to do at the end of the year. Is it going to be higher or lower? I would imagine that if the market can, tolerate and digest good employment news that we'll see this week. So we have non-farm payroll this week, right? On Friday. So Friday's non-farm. This week we do have some PMI numbers coming out of the U.S. So Powell's due to speak this afternoon at 2:00. Tuesday, we have Eurozone CPI. We have ISM. What's the manufacturing PMI numbers coming out of the U.S.? We have job openings as well for the U.S. at 10 a.m. Tuesday. Wednesday, ADP is a non-farm payroll precursor to Friday. So forecasting 124. Last one was what was the forecast? So 144 was the previous forecast, came in 99. ADP has never been like a big. It's never been a big. I'm never like trading ADP non-farm on Wednesday. It's interesting to see what the print is. Is it higher or lower than expected? But Friday is the big one. So light data this week outside of the PMI numbers. If there's going to be any type of reaction, that's at 10 a.m. tomorrow. And then Thursday we have unemployment claims, which will continue to be a sensitive spot, making sure that our unemployment claims are staying relatively quiet, or calm or consistent, as opposed to spiking higher, trending higher. And then non-farm payroll on Friday. Average hourly earnings expected to be 0.3, non-farm expected to be 44, and unemployment rate, which is probably what the market's more sensitive to, will it be lower? So we peaked, that August non-farm print peaked at 4.3. That's what activated the SOM rule. Again, historically accurate rate cut cycles. I mean, all these things, it's like there's a reality check that the market's going to have to deal with. You can call it a recession, but it's probably going to be something else. And the reason why is too many people right now are in the recession band camp or the bandwagon, that if everybody expects it, it's going to be something else. Like, the market is very good at misdirection. Everyone thinks one way, the market does the opposite, right? If everyone thinks it should be a bearish market or should be a recession and everyone's positioning for it, what's the pain trade? A melt up, right? A melt up. So I wouldn't be surprised if the market finds a way to melt up and ignore what we think is fundamentally going to rattle the markets. But here's where the market's going to be moving. Okay, look, U.S. employment has to be steady. Okay, so let's chat about this for a second. Priced to perfection. Historically, when you go back to 2020 valuations, 2007, 2008 valuations, 1999, 2000, 2001 valuations, we're not quite overextended at those levels, but we're pretty darn close to them. Okay, so we need to see employment data has to be steady. The market probably doesn't want to see higher unemployment rate, doesn't want to see a miss in average hourly earnings, doesn't want to see a miss in a disappointing non-farm number come out. The market right now wants to see good news is the U.S. economy. Job-wise, we're steady, we're stable. U.S. economy, we're still growing, right? It has to be steady. So I'm sure the markets don't want to see any bad surprises with the U.S. right now. Let's talk U.S. inflation. Has to continue to trend lower. This is the concern that I think everybody should be watching through like Q1, Q2 of next year. There's a lot this market can ignore for the next 3 to 4 months. We have an election. We're going to figure out what that looks like. Is it more of the same? Is it going to be a crazy sweep with one side or the other? That's the only thing I'm really concerned with as an election, is if it's all Republicans taking over everything, or is it all Democrats taking over everything? I don't know. That's the only real thing I would think would be disruptive to the markets. If it's more gridlock where, you know, it's divided House, Senate, nobody wins, branches are all checks and balances, it gets passed, right? We know that pretty much Democrats, Republicans right now in the U.S. hate each other. It's a super polarized system, and you toe the party line. You never go bipartisan unless it's like military, and that's what our country is right now. So is it good or bad? I don't know, but the markets tend to like gridlock. So if gridlock is available, then the market's probably going to continue to do what it does, which is find a way to go higher. But inflation, if we are adding money supply, so the U.S. money supply has gone up, China money supply has gone up, global money supply going up, that liquidity will find its way into the markets, probably causing more of a melt up. And you could argue that that melt up is going to equal some type of asset bubble, some type of deficit bubble, some type of debt bubble eventually. Could be in the near term future. We don't know. But inflation data has been trending lower. You know, we had a peak in 2023. When was our peak inflation for CPI was that 2022, like 9+%? And we had about a year of stickiness around the 3% mark, and then we finally went to like 2.9, and then we printed 2.5 year-over-year CPI. I mean, inflation's been trending lower, but with global money supply, if it increases spending, that's likely going to be inflationary. So I still think the markets are going to struggle to see if asset prices go higher, inflation pressures go higher. I don't know if the Fed can get, or I don't know if we can see the CPI year over year get back to 2%. I wouldn't be surprised if what we see this month might be the lowest that we see in inflation for a while. Let's say we come close. When is inflation, by the way? So this week's employment news. We kick off earnings season next week as well. So earnings season kicks off with the financials on the 7th. Cash rate for the RBNZ. Here we go. So Thursday, October 10th is going to be CPI year over year. There's no forecast right now. Previous print was 2.5. I wouldn't be surprised if we forecast and we're printing lower. If I go to, let me go to Trueflation for a second. What's the trend here? Right now, if I just go to inflation index. Okay. All right. And again, this is a third party reading. So Trueflation 1.5%. Previous print was 2.5. But what I want you to notice here is look what this is. What is that right there? That's not trending lower. We just went from this big trend lower to then bouncing here in the last 2 weeks. So I could see the CPI reading coming in lower than 2.5. The market gets all excited about it. But the reality is we might have actually put in the bottom, and all of a sudden our inflation is going to be right here. And it's going to remain sticky. But I don't think the market's going to care necessarily until we get through this year, maybe into Q1, Q2 next year. And then the market realizes, hey, wait a minute. This inflation report that we're seeing every month, year over year reading is not getting better. It's not closer to 2%. The Fed keeps talking about 2%. And I do wonder as we go into next year, like, will the Fed continue to cut crazy aggressive like the market thinks it's going to, or that be a backpedal in 2025? So am I worried about it right now? No. I think that the market will continue to see, you know, better data and you know, favorable data. As long as we don't lose our butts on the employment side, then I think the U.S. market's going to continue to hum along just fine. Okay, but price to perfection, a lot of things are happening here. Employment data has to be steady and solid. Inflation data has to continue to be steady or lower. And I would say that earnings, okay, so U.S. earnings has to continue to, I would say, beat expectations and likely have positive forward guidance. That is the one concern that I have going into this year's earning, or this season's earnings, is if there's acknowledgement of a, you know, tightening consumer, or there's acknowledgement of a slowdown, it'll be interesting to see what the overall consensus is. Okay, so we all, and on top of that, we have, you know, U.S. election drama, which we know we're going to have it. This week, I think we have the vice presidential debate on Tuesday night. I don't think that's a market mover, but and I don't think it will be. But there's obviously, as we get closer and closer, there's more uncertainty. Who the heck knows? Is one side doing some type of crazy Hail Mary thing? I don't know. but there's going to be all these things, right? So this is a lot for the market to be digesting. This is a lot of potential chop and volatility. Once we get through the election, I think the market will look at all these things and say, is it positive? If so, let's go. Okay. If we get through the election and all this is mixed, right? Like a plus minus, maybe the market's a little bit drifting higher, maybe melting up a little bit, but not as fast paced. Or if this is all negative and we get through the election, maybe the market doesn't like it. I would say that if I'm forecasting here, my higher probability is the market's going to find a way to be higher. You know, we're already trading near, I mean, we're at all-time highs, right? We had several all-time highs already hit on the indexes. This is a weekly chart. Let me go back to the daily. I want to say the SPY has crossed over 40 all-time highs this year, which is pretty darn good. Our last high we would have seen on Thursday last week. So Thursday all-time high. Before that, it was the Thursday after FOMC. So we had FOMC right in here with that rejection candle. And then Thursday was a massive gap to the upside. So that was our previous all-time high. And then last week as well. I wouldn't mind seeing some volatility to the downside. In fact, I may look at a short-term hedge. Let me look at like an ES or I'm either gonna go ES or MES for micro, but I'm probably gonna put on a bit of a hedge. Let me see if I can get back down to like 561 on the SPY. Does that actually, this might be pretty cheap. Let me go to like a 561 put on the SPY. So if I go SPY 561, how much further out do I want to go? I'd like to get through the election. Probably November 15th. It's a good monthly expiration. There should be plenty of volume there. If I wanted to hedge out through November 15th through the election, any type of drama, and if this is something I can take profit on earlier, I'm fine with that. Right now, oh my gosh, dude, $8 for a put. I'm not taking that trade.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.